And we should be live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special report with my good friend, Axel Merk, who is one of the best Fed watchers in the business. Axel, great to see you again. Thanks so much for joining us today.
Great to be with you, and my compliance hat comes on right away. I cannot accept any endorsement, otherwise my compliance is going to chop my head off.
I can't even say you're a nice guy.
I even there have to put in a wonderful disclaimer that is, yeah. Anyway, it's been a long day. It's great to see you.
Great to see you too. All right, so we have a lot to talk about, both with what the Fed announced today. I also want to talk about the upcoming horse race on who might succeed Chair Jerome Powell. I also want to talk about the political pressure that's being applied to the Fed in the middle of all this, with the lawsuit against the Fed chair and Lisa Cook. And then I want to talk about gold and silver, which have been positively, I don't know, white hot on fire. Those feel like two pedestrian adjectives. It just doesn't seem to capture exactly how crazy the action's been in the precious metals. So we got a lot to talk about. Also want to talk about the miners, which is in a specific area of your expertise, Axel. So we'll try to condense all that into the hour, folks. Please do me a favor. Let me know where you're watching from. If you're watching live, it's always really useful to know where the audience is tuning in from. So Axel, also let you know too, I've been recording all day. In fact, I literally just came from recording a long interview with Michael Oliver, whose predictions on the precious metals folks are mind-blowing. And that video is going to release tomorrow morning at 11 a.m. Eastern. If you care at all about the precious metals, you're definitely going to tune into that. So Axel, I haven't actually had a chance to watch Jerome Powell's press conference. That being said, so I'm going to lean on heavy for anything coming out of that on you. But that being said, the Fed, pretty much as expected, left rates alone this time. There were two dissents. Stephen Mirren, which of course everybody expected him to dissent because he wants more cuts. Also Christopher Waller did, which some is wondering if he's trying to throw his hat in the ring for taking Powell's job. So two folks wanted it lower, but they decided to hold it steady for now. The rate cut odds for the year continue to fall. I think right now there's just two rate cuts that the market is expecting for the rest of 2026. What I took from at least the release was the following. The Fed has upgraded its view of the economy, saying that economic activity has been, quote, expanding at a solid pace. The Fed, while it did repeat that inflation remains somewhat elevated, Jerome Powell himself said, hey, the upside risks to inflation have moderated. Similarly, the Fed removed the language from its statement that used to note that downside risks to the employment rose in recent months. They took rid of that and tweaked the description to note that job gains have remained low, but the jobless rate has shown some signs of stabilization. So in the one little clip I did catch from Jerome Powell's press conference, he said, hey, look, upside risks to inflation have diminished and downside risks to employment have diminished, which basically means we're feeling a little bit better about the economy, which they did note has been now expanding at a, quote, solid pace, which is a large part of the rationale for why they decided they could just hold pat this quarter. I want to dig into that a little bit more with you in just a minute. But were those the things that you thought were most notable, or were there other things that caught your attention?
Well, they were all that. I think that was an excellent summary, especially for somebody who didn't listen to it. The one thing that struck me maybe the most is the one thing that nobody has pointed out is that the trading activity into the Fed meeting was somewhat normal. And I say that because usually there's the suspense ahead of the press conference. And then there's this release. Now, and that happens even during times when people think there's no change. Mm-hmm. And I attribute that to Powell being a lame duck. It didn't really matter so much what he would say. Obviously, if he puts his foot in his mouth, then the market might react, and he tried desperately not to do that, declining to answer numerous questions about the politics of it. So all he says that the only thing he said on the political side is because Besant, when he was in Davos, said he thought it was inappropriate for Powell to go and sit in the audience at the Supreme Court during the hearings, and he went anyway. And what he said, it's one of the most important decisions that's ever affected the Fed. And by the way, Paul Volcker in the 80s also attended a Supreme Court hearing, and so he decided to go. There wasn't really much of a marked reaction. And then while you're saying, yeah, there are many rate cuts, there's less priced in, there wasn't really a change between before and after the meeting. So the press conference did not really move the markets. Afterwards, price of gold moved higher and the like, but didn't terribly move the markets. As you point out, right, he kind of said, oh yeah, both sides of our equation, they kind of look better. But he was asked by several people, well, do you change the balance of risk? Is it in balance? And he pushed back at any one of these things. And the short of that is that he wanted to leave today's decision on its own, didn't want to give any forward guidance, say, hey, we're going to be data dependent. He was also asked, hey, is the next move up or down, or what is it? And again, he didn't say anything. And so he very hard tried to not introduce any bias. And in many ways, that's healthy, because you don't want to give forward guidance. You're supposed to be open-minded on all that. And then just briefly on the Waller dissent, several people tried to point out, oh, maybe he does that because he wants to get the job. And I was on Twitter and pushed back against that. I said he's going to do what he thinks is right. And the reason is, and we'll get into the Fed chair competition, but I disagree with the candidates on policy and on substance. I am not questioning their personal integrity. Okay. And maybe in an audience where everybody hates the Fed, that's a nuance that others don't care about. But I do think it matters when it comes to analysis. And for what it's worth, right? Powell was asked, so where are we relative to neutral? And he said, well, we don't really know where neutral is. We must move closer to neutral. Something gets a little lower and the like. And so the short of it is that Powell is somewhat happy where they are. So seems to be the majority of the Fed. The two dissenters are not. So he didn't really say much that was new. And as you know, I've mentioned in discussions with you before, why hold the press conferences if you have nothing to say, right? The journalist did a good job laying out a whole bunch of traps. And I think for the most part, he was able to avoid them.
Okay. So did you watch the full press conference?
I did, yes.
I'm curious, what was the tenor of the journalists there? Like over the course of the past year, I had noted that they'd become kind of increasingly pushing back on Powell, like, hey, you're telling us the economy's fine, but we're hearing all this other stuff. Was it that contentious, or was it more friendly this time?
Well, it was contentious only with regard to all the political questions.
Right.
And,
okay. Which Powell basically said, I'm not going to answer, right? Not the time.
Which he's in various different ways. He was, and there was even some chuckling going through the audience at question after question. He kind of indicated that he's here to kind of focus on monetary policy. Okay. He said the stuff central bankers say, there's broad support for holding. And he said, I'm quoting here, I'm not making a judgment. One is more at risk than the other regarding the mandates that they have. He was asked several questions about the dollar. And the one thing where I don't think he's correct, but at least that's what he said, and maybe he was supposed to say it. The one thing he said about the dollar, he did not see that foreigners have changed their behavior with regard to the dollar. And so that's a proper answer, but I don't know whether that's the accurate answer.
Mean in terms of purchasing U.S. debt, or? Yes,
exactly. Okay. I mean, I think the data speak for themselves that they're not there as much. But
okay. Can you talk about that then? How, if you're seeing a delta in the data, how large is it? What's the trajectory look like? How worried are you about it?
Well, I think we've talked about it. When you have tariffs, you don't just impact the flow of goods, you impact the flow of currency. Mm-hmm. And so less currency makes it back into the US. And you see that in stubbornly high borrowing costs, that the bond yields are lower because there needs to be more. I attended an academic session at Stanford the other day, and they framed this as excess liquidity, which is, of course, one way of looking at it, is that the world is in demand of U.S. liquidity and gets it from treasuries, gets it from the U.S., safe assets and so forth, the demand for safe assets. And if you inhibit trade, there is less demand for that liquidity. You can translate it to the exorbitant privilege as well, and so forth. And you see that, and very different. Malpass wrote an editorial in the Wall Street Journal today, and he said, "Oh, the long-term rates are pretty much only a function of cumulative short-term rates, and the Fed has it all wrong." Well, that's a bit too simplistic. There are a lot of things that go into the long end of the yield curve. And it's the appetite. It's, of course, the appetite, generally speaking. A treasury bond does not care whether an American, a Chinese, or a Brit buys that treasury, right? It just cares about demand. But if you disincentivize foreigners to buy your debt because you might sanction them, because you might get into a war, because you want to get one of their islands, because you are making it more difficult for them to trade, there are implications. And a lot of the views that have kind of been some more on the fringes are coming to light in the current environment of what we're seeing.
All right. So from a level of concern standpoint, where are you? Are you just seeing some initial things? Or is this a trend where you're like, look, this is, I mean, I know you study currency flows a lot because you had currency funds there at Merk.
Yes, we used to be very active in that space. Now we're quote unquote only doing precious metals. Let me put it this way. The markets have humbled me many, many times over. Of course, I like to have a narrative, a macro narrative as to why something is happening, and I've shared those with you many times. I'm actually usually quite happy when things move in my direction. I am much more concerned when things are actually playing out almost too good to be true, because it means that the market might have caught up with where I am. And that also means that I might be lagging behind in what might be coming next. And so by being right, I'm actually not in a comfortable spot. And if there is one thing, today, as we're talking, the price of gold, the spot price of gold, is up $237, 4.58% as I'm speaking. And by the way, if others have slightly different prices, this is from Bloomberg. Sometimes people use a different reference price with closing price. You often look at the futures price, which is often a little bit different. Right? Futures are up $237. They close earlier, but still, it's a different reference price. I did not think that was extraordinary at all. And to me, that was concerning that I thought, well, hey, up $200. Almost as if that were the new normal, which of course it isn't. And so the thing that I think I've mentioned to you as well is that these precious metals markets are so small that so smaller changes in allocations can have a big impact. And kind of tying it back to the Fed, as you know, we've worked with Bill Poole since 2008, the former St. Louis Fed president, and he once told us that, of course, the Federal Reserve has the bazooka. Actually, he said it before the term bazooka was too popular. But ultimately, central banks are just sipping from a straw in the ocean. And so if the markets want to do something, the central banks aren't strong enough. And David Malpass, when he had his editorial, he said, oh, the Fed should lower rates and then make sure the dollar is strong. Well, you can't do that, right? If you coerce rates to be artificially low, there's going to be a valve. It's just the dollar. And of course, President Trump said that, oh, he's just fine with where the dollar is. Everything is great. Bessent then came out today and reiterated the famous words that the U.S. is always interested in a strong dollar policy. Incidentally, the Financial Times rephrased that quote and said, and the US is still interested in a strong dollar currency policy. And so those are interesting nuances. But I'm kind of getting ahead of myself here. To answer your question, I do not know where this is going to lead to tomorrow, but we do have an administration that wants to push growth on every cylinder, wants to leverage the productivity boom. So we have deficits as far as the eye can see. We're getting a tax refund to push the economy. We're presumably getting a Federal Reserve that's going to play along, keeping rates accommodative. We have Europe spending over $1 trillion in infrastructure spending and military ramp up. We have on top, this was before the quote unquote disagreement happened over Greenland, really encouraging Europe to get its act together on defense spending. And obviously Mark Carney had this quote in his speech in Davos saying that the power of value is being superseded by the value of power. German Chancellor Merz doubled down and said, we got the message, and we will rearm. And so to me, that sounds like a world where a lot of money is going to be spent. And deficits are going to be significant. Note what I didn't mention is that, oh my God, we have to cut back social spending in the US and Europe, maybe other places to finance all of that. I did not hear. And so we did see in Japan the bond market react to some adventurous spending ideas of the administration there. So bond vigilantes are starting to wake up. If that were to happen in the US, I have no idea where this is going to play out. I mean, we are at the 10-year yield as we speak at 4.24. The 10-year real yield, and I know nobody knows what real interest rates over 10 years will be, but I look at this measure as a measure of confidence in the Fed, is at 1.88%. So that's been hovering around this level. So if you look at confidence measures in the Fed, they are quote unquote well contained. They haven't broken out. But if you look at other metrics like the price of gold or silver for that matter, right, it's gone through the roof. And so there are some astounding movements in these markets. And the question is that because of the fundamentals, or is that because of speculation in the market? Now, of course, there are speculators in these markets. And a run-up will attract speculators, but anyway, I'll pause here because I don't want to just speak for now.
Okay. Well, so I don't know if you saw, but I flashed, and I'll do it again. I'm putting up the current gold and silver futures here on the screen, and yeah, as we've been talking, gold futures have crested above $5,400 an ounce for the first time. That's bananas to say, especially not even 36 hours since gold hit 5,000 an ounce for the first time. Silver is very close to an all-time high, which of course it hit just a couple of days ago as well. So yes, there's a lot in the soup. I'm sure there's a lot of speculation in here right now, but how much of this move that we've seen, Axel, over the past 6-8 months, do you think is a loss of confidence in the Fed, and then in central banks and just, fiscal deficit, any pretense of fiscal constraint going forward?
I think it's a loss in confidence in the fiscal sustainability. It is not a loss in confidence in central banks. And the reason I frame it that way is if we had a loss of confidence in central banks, all hell would break loose. We don't see that. If we had a loss of confidence in central banks, long-term inflation and expectations would be unhinged. Now, to take a step back, maybe.
Okay, that's a good point, actually.
You can get away with mediocre monetary policy if the fiscal side is in order. But if the fiscal side is not in order, even good monetary policy can't save you. We know from Draghi and obviously from other incidents in monetary history as well, that when push comes to shove, central banks will do whatever it takes. Now, what Kevin Warsh, one of the Fed candidates to succeed Powell, has said is that the zero interest rate policy literally egged on Congress to engage in excessive spending. And so in that sense, the Federal Reserve is a contributor in that fiscal situation that we are in. But monetary policy, and we can talk about it, we can talk about what we like and dislike about it, but there is no loss of confidence. It doesn't mean I agree to what they do necessarily, but the market continues to have confidence in the Fed's bazooka. And so I think that's factual based on what we see in the markets. Now, obviously, the precious metals markets in particular have said, hello, hello, hello. It's a bit like a canary in a coal mine that's been kicked out of the coal mine for singing off tune and too loud, right? It's just saying, screaming, something is happening. And it's, of course, hiding in plain sight, right? I mean, we got 6% plus deficits as far as the eye can see. That has implications. And if you have the floodgates of liquidity open, even with the modestly restrictive policy that the Fed says that they have, you can push asset prices higher all around, right? I mean, the one thing last year that is notable during this amazing rally precious metals had is equity markets did just fine, right? Historically, more often than not, when gold does well, equities do poorly. It's one of the reasons you invest in precious metals as insurance, right? To be different.
Mm-hmm.
And clearly, precious
an
metals,
alternative asset,
and it dramatically outperformed. And but still, usually the kind of the juxtaposition is one goes up, one goes down, and that didn't happen. That didn't happen in 2022, and of course, year to date, right? I mean, if that said, if you look at there's still some of the Max 7s are still down year to date. I see two of them here on my screen. The others are, in the meantime, mostly flat. But it's a very interesting world that we're in now. Is it based on fundamentals and or is it something else? I do think that we've had very volatile fiscal policy in the U.S. If you take the executive actions that have happened in the U.S. as fiscal policy as well. And the U.S. economy has held up very well under that, better than most people anticipated.
Mm-hmm.
But there are implications. And one of them is that the price of gold is higher, right? And there are implications that the bond yields have not been coming down and have been stubbornly high.
Right.
In Japan, these are movements. The Swiss franc is up through the roof as well, right?
Mm-hmm. To your point there, and I think this is a really interesting point, is a lot of people that are sort of cheering on the whole gold thing, the gold bull market here, the gold rush, is, hey, this is a monetary repricing. Everybody is giving up on fiat dollars. This is collapsing in front of our eyes here. But if it were, if the market truly expected higher inflation from a rapidly depreciating currency, then you would see these inflation expectation indicators rise, wouldn't you? Wouldn't you see we wouldn't see the bond market just holding steady. We would see the bond vigilantes really dramatically taking
this is somewhat what I meant is that I'm shocked that I'm not shocked by a 200 price move in the price of gold, because it feels normal. And I don't think we've seen anything yet. If there were a dislocation, these markets would look very, very differently.
Right.
And
so that gets to what is driving the price of gold, or is this gold just calling BS on fiscal restraint?
I mean, we like to put a story on it. Of course, we don't know, but I would think that it is more people that are embracing the views that the gold bugs have historically embraced. Mm-hmm. People don't trust bonds as being the diversification safe haven that they have been. Not that gold is a perfect substitute, not that those investors are putting all their money into gold, mm-hmm. but because the precious metals markets are so small allocations have a disproportionate impact.
Right. And sorry to interrupt, but I want you to include this in your answer. How much of the rise right now, or the drive for that, the new capital coming in, how much of that is due to central bank buying? How much of that is due to international buying, especially in Asia, which has been hot for the past couple of years? And how much of it is due to the new at the table Western buyer who was saying, you know what, I think I'm going to take some of the money I had in bonds and put it into precious metals?
Yeah, the short answer is we don't know. Because the numbers from central banks are late. We can't always trust them. And keep in mind that when you talk about central bank buyers, we historically talked about the folks who are historically hostile to the US because they were worried about getting their money confiscated if they keep it in the US. And so they have been trying to look to reallocate. And by the way, they are not looking to impose a gold standard somewhere else. The other countries have as much deficit spending as the US has. Maybe not as much, but significant. Some of them might have more. But but we have new players in that, right? I mean, this aggressive move against the NATO allies gets other countries to think about, well, do they want to keep their reserves in the US?
Right.
There's been calls in Germany to repatriate more gold from the US. And they're not going to take all the gold tomorrow, and they're not going to sell all the US treasuries tomorrow. But on the margin, those changes in allocations do have an impact. And so what's somewhat unique about central banks is that they're not very price sensitive. The typical buyer, retail buyer, is far more price sensitive. And by the way,
Right.
It's just to be clear, because we talk about all this demand. Whenever there's a transaction, there's a buyer and there's a seller. We tend to forget that sometimes. And I don't know whether I mentioned it to you when we last met. The wholesalers in the US are actually of precious metals are actually not doing great right now. And the reason is that a lot of people are handing in their coins. And so on
they're choking on silver right now.
Yeah, the coin dealers are getting a lot of supply, which means there's little demand of new coins from the mints. And so is that
why the mint is being so stingy right now? And that's
why there's supply shortages on some of the new coins. Yeah, because they're not being ordered. And the wholesalers don't want to carry that inventory.
Okay, but that's not due to the mint having trouble getting the metal.
No,
it's not so much metal circulating.
No, there is a lot of metal circulating, and so it is a two-way market. And by the way, it's one reason why I don't think we're in. I mean, obviously, the price of silver has gone to the stratosphere. So, but we don't have the typical signs of a bubble in the sense that there is a two-way market. There is still, you had an interview just a few days ago. Most folks who own gold have held gold for a while. There's a very small percentage of people that is a first-time buyer of gold. And maybe in your audience, in my audience, it's a bit of a biased sample. So I don't think we can do a completely neutral survey on that topic. But it is still, also, if you look at the holdings, Bloomberg tracks the global holdings of the physical gold ETFs. They exclude China in that. That's a separate story. And we are not at the peak in ounces. We are at peak in the dollar value. The same with the silver ETF. We're at the peak. We're not at the peak in ounces, but we're in a peak at
market value.
At the market value. And just brief comment on China. China has several precious metals products, and the popular ones are based on derivatives. There's a silver product that trades at a 40% premium, and they are clear signs of speculation. It's one of the challenges in China that the investment culture is not so well developed, and so people are squeezing into things. So that sort of stuff can create volatility, especially when then some people are starting to lose money and then there's a flight to the exit, right? So I'm not suggesting that the extreme gains we've had in silver in particular are not going to cause some outsized volatility that can also hurt on the downside.
Okay. That's been a topic of great discussion over the past couple of days, are we in some sort of short-term blow-off top? Obviously when we've had vertical price action like this before in the precious metals, the correction has been violent, and not only violent to the downside, but then the precious metal prices were kind of dead money for like a decade or more. So there are people that are wondering, that happen again, and if so, do I get out now or?
Well, let me talk about that briefly. Of course, it can happen, and it can happen for any reason or no reason. That said, remember last time that silver got beaten and was dead after 1970s? We had Paul Volcker come in to impose discipline on the market. We had Ronald Reagan. He had an expansionary fiscal policy, and he had deregulation. So in that sense, it's similar from the current administration. But I think that's where the similarities end, was clearly, and there was a Plaza Accord as well, of course, that happened at that time. But Reagan was perfectly okay with a tight monetary policy to break the neck of this stuff. Now we got the opposite. We got an administration that's really pushing to keep rates low, with the argument that when you have a productivity boom, you can keep rates lower. And to an extent, I agree with that. There's some nuances I have problems with, but that's a fair argument. But that is historically not the argument. I mean, in many ways, right? We have a king of debt, president of the country, and he's going to be in office for another few years. And so, sure, it's possible that we're going to be whacked with something that's going to kind of put us into a new ice age in precious metals. I just don't see where that's coming from.
Okay. So now, you do think, quote unquote, it's different this time?
Well, I'm trying not to use those words, right?
I know.
And that is because, I mean, and I'm so happy that you got rid of your silver coins. That's
I've been getting a lot of grief that I did, just so you know.
No.
There are a lot of people who are unhappy.
I was very concerned about your mental health while you had those.
Well, they did their job, I can say.
They did their job, yes. But the question is, where's the supply and demand coming from? Kind of, you asked where it's changing. There are more people looking at that. To give you an example, and I may have mentioned this to you before, we extensively invest in gold miners. And so the executives of some of these gold mining companies report to us when they go on a roadshow, they now have generalists in the room. So fund managers of the big active mutual funds, actively traded ETFs, actively managed ETFs, they come in and try to understand the dynamics in the mining sector, which of course it's a little different from how most of these, how they value most companies. But that's big money flowing into a very, very small sector. And the question is, of course, always, how long will this last? And the thing is, the history of gold mining is such that we just don't know. Is the funding window, is it open for 3 months or 6 years? And you can make the argument either way, right? And with regard to, is it different this time? Well, I mean, clearly having such massive debts in peacetime is different. And if there's any problem or the reaction, if we had a major stock market crash, right? We don't want to do the same playbook as the Great Depression had. And so we know the playbook of the central banks. Now, it does make a little bit of a difference of who the next Fed chair is, but it's a world where we kind of know the parameters of the central banks. We are trying to go at full speed. The global order is over, and I've mentioned this before. Mark Carney said it in Davos, right? Alexander Stubb, the Finnish president, kind of has had the same theme. Now, he tries to preserve it, but the point still is that we don't have this global rules-based order anymore. Everybody's in it for themselves. It's the strongest is going to prevail. New alliances will be formed. And there's going to be a lot of friction along the way. And friction is a very polite way of saying that this could get ugly and expensive.
Right. And to fund this new order, they're going to print.
Unless they're going to come to their senses and say that the biggest threat to peace is deficits. Because if you don't have sustainable deficits, you can't afford your defense.
But nobody's saying that right now.
That is not what I hear out of Washington or any capital these days in the world.
Yeah. Okay, so Axel, let me just in the interest of time, let me take us to a few other topics real quick. Though, a couple quick things. One, thank you HCH for reposting the stream, folks. If you know how to repost the stream, please do, so we can get other folks involved in the discussion here. I do want to try to get to at least a few user questions before we're done here, Axel. But a couple questions before that. Before we hop off just the dynamics of the Fed here, I recall Ron Paul. I had the privilege of interviewing him a couple of times in years past, and he would always tell a story about meeting with Paul Volcker and having Volcker several times during the meeting turn to an aide and say, "Where's the gold price?" Right? It was something that he looked at really closely because it was a mirror to the dollar, right? It was sort of a confidence mirror, right? And a lot of people think that attitude had maybe persisted long past Volcker, when people were frustrated thinking that gold's being suppressed or silver's prices being suppressed or whatever, right? Right now, it kind of seems like the administration or the existing powers that we have right now kind of just said, I don't care, let gold do what it wants. We're going to do our own thing.
The only person who even understands gold is Besant, the Treasury Secretary.
Who likes it, by the way.
Yes, but and he might be scratching his head what's happening here, and that's partially why he came out today and said the U.S.
He has reiterated
strong
too that it is
dollar
his largest
policy.
holding.
Here we go. So he must be doing fine. But I've had the honor of meeting Volcker, I've engaged several of the Fed officials, both present and former, and they don't pay attention to gold. They could care less about it. They care about their dual mandate, right? And so they'll have something general that they can say about it, but they're not looking at that.
Okay.
It doesn't go into the models. It doesn't go into their thinking. It's a sideshow, and for what it's worth, it's a sideshow for most people. Right? I talked to a journalist earlier this week, and she wanted to know about fund flows and this and that. And at some point, to make the point that there is no drive by retail to get into gold, I asked the journalist whether she owned any gold, and she was surprised I asked her the question, and then she said no and chuckled, and I said, well, exactly, that's how most people would answer that question, right? It just doesn't come to mind. It's something foreign, it's something strange.
On average, I believe the percent of holding in the average portfolio is 1%, 2%, maybe. I don't even think I think it's probably still lower than that. But that's average, right? If you look at it on a median basis, median person owns zero, right? So it's still heavily under-owned. Totally get all that. Hey, real quick, since you mentioned that you met Volcker, you're a pretty tall guy, Axel. I mean, we're about the same height. Did you feel pretty tiny next to him?
That's for those who are on this chat here that are tall. They can relate to this. If you're tall and meet somebody who's taller than you are, it's really odd. Right, because we're used to talking like this, and if we have to talk like this,
yeah. And he wasn't just an inch or two taller than you. He was about 6 inches.
I get some practice. I'm 6'4" or 6'3.5", as I have to be more precise. My son is over an inch taller, so I get a little bit of that.
A little bit, yeah. But I think Volcker was what, like 6'7", 6'8", something like that.
He's
Okay, so folks, I'm going to get to minors and then I'll get to your questions. But real quick, let's get to, I do want to talk about the candidates for replacing Powell. We don't have to spend a ton of time on it, but I'd just like to get a sense of your current guesstimate of who you think might take it and whether you like them or not. But first, the Fed remains under fire politically, right? I mean, there is an active lawsuit by the Department of Justice against Powell. I'd love to hear any thoughts, reaction you have to that or whatever, but let me ask you this question. Why do it, right? I mean, Powell, as you said, he's kind of a lame duck at this point, and he's out of there in just a couple months. Like, why rock the boat so dramatically here? Because this cracks open the whole question of Fed independence and all that stuff, right? Is there a valid rationale for doing it now?
First of all, while we talk, if you can put up a live web page, pull up the Poly Market web page on the next Fed chair. and that is interesting. So I published a newsletter just a few days ago. You can find it at merkinsights.com, where I talked about the importance of Fed independence, and I mentioned to you, and let me just reiterate it because I think it's so important. The monetary policy is about setting interest rates, about money supply, about credit in the society. Monetary policy is not about allocating that credit to specific sectors of the economy. That is fiscal policy. When the Federal Reserve veers from monetary policy into fiscal policy, surprise, surprise, they're getting backlash, because then elected officials will want to have a say. And these ivory tower academics at the Fed have done that since the financial crisis. When you buy mortgage-backed securities, that is fiscal policy. It is not monetary policy, because you're putting money into the sector, the real estate sector. And the extreme cases, of course, during the pandemic, giving direct loans. I think also paying interest on reserves is a terrible idea, because you're literally paying tens of billions to banks, inviting political scrutiny. And so the backlash that the Fed is getting is in the context of that. Now, the reason why Fed independence is important is because it makes monetary policy cheaper. The cost, we talked about how the markets are well behaved, how inflation expectations are anchored. Well, you can throw that out of the window if Fed independence is lost. And the reason is that Fed independence is so important because the Federal Reserve can print an infinite amount of money. And so if Congress gets its hands on that printing press, all hell breaks loose. And so if you have a credible interference, not just if a president complains about the Fed, almost every president in history has done that since the Fed has been created, but if you have credible interference, then that is dangerous in the sense that it can disrupt that. Now, none of this means that I agree to many things that have happened at the Fed. And by the way, Bessent rightfully, he listed a laundry list of things that have happened at the Fed, and then said if that happened in any company, the CEO would have been fired. I agree with that. Maybe not on every nuance that he said, but in that sense, Powell's a lame duck is going to be out anyway. But that is why the Supreme Court case is so important. Now, the context here is that Congress has the power to control money and regulate money, not the executive. And that is why for the monetary function, it should be Congress that impeaches a governor or president rather than the executive removing. Now, reality is a little bit more muddy than practice, because the Federal Reserve has several functions that are more administrative in nature. Think about much of the bank supervision, where you can make the argument that, yes, they should serve at the pleasure of the president. So in an ideal world, you should separate these functions, and monetary policy should be set by somebody who can only be impeached, and the president can fire folks on the other end. Now, the Supreme Court has the pleasure of sorting out this mess.
Correct. And that's mostly around Lisa Cook, though, right?
Yes, but it's like taking it a step at a time, right?
No, totally.
He's not going to fire Powell before the term is up. That's posturing. It makes no sense.
Okay, yeah, and I just don't even know why they let it get to this stage when there's a couple of months left.
Because we have a president who likes to drive the news cycle, right? I mean, why do you think we have such a hoo-ha about invading in Greenland when the U.S. has military bases and free access there already for everything? Why? I mean, the Wall Street Journal had a great article that it's a money pit. Every Greenlander gets subsidized by $20,000. Now, the argument that, hey, if you want to do things properly, you might as well own it, I get that. But they can always seize it if there's a war, right?
But you think it's maybe more of an intentional smokescreen? Let's get everybody just focused on this while I do.
Well, and then you have a deal and everything is happy. It's a particular style. I mean, the essence is that.
But what deal are they looking for with the Fed? Like, that's what I don't get. Like, I just don't.
They want lower rates at the Fed. and I want everybody to be happy.
So
with
this
it.
is just pressure. This is just a pressure tactic. Then.
This is a pressure tactic. Yes.
Okay.
Yes.
Okay. All right. That makes sense.
So, and we can expand on it, but let's talk about the next Fed chair. The reason I asked you to pull up this live feed, and I don't know whether you can briefly show it, as we're talking exactly, the Rick Reader here has fallen down, and Kevin Walsh is also down from where he had been. Chris Waller, having dissented, is slightly up, but Rick Reader was I think at 45% earlier today. And to just for those who don't eat those names for breakfast, I had been talking about how the candidates for the Fed were all somewhat reasonable and all they different in style, and I have my preference. When I made those statements, I did not have Rick Reader in mind, because at the time he was so far down in the likelihood that it wasn't the case. And first, and as those who've listened to you with me before know, I have a strong preference for Kevin Walsh. Yes. And the reason is that he has, for 15 years, been consistent in criticizing the Fed's transgressions. He is the only one who would get the Fed out of politics. That is the right thing for the country. It's the right thing for monetary policy, to put some sense into the Fed, right? Everything beyond that, and he rightfully says, well, the Fed's job is really not to mess it up. You don't need, and he's quoted conversations with Volcker, not that Volcker would look at the gold price, but he would say, well, what changes inflation from 1% to 2%? And when this was 30, 40, 50 years ago, and Kevin Walsh would tell Paul Volcker, oh, it's up 1%. No, it's up 50%, right? Looking at it from this point of view, but making it clear that Fed policy is not about getting the second decimal right, getting the big picture right. Rick Reader, he believes that raising interest rates is not the right tool to fight inflation. He says it only has an impact on housing, and the poor. Inflation doesn't really have much of an impact otherwise, but he implies that he might want to use it for those, and he has said he would use the balance sheet more proactively. And while he hasn't specified exactly what that is, those are the sort of things that get the Fed more into politics. Mm-hmm. Now, he's all on the supply side, and he would lower rates and let the economy run hot. The other candidates would somewhat do the same, but for different motivations, different reasons. Kevin Walsh, by the way, is on the productivity bandwagon. Chris Waller, who dissented today, he is kind of an independent spirit who has been right on many calls. He warned about the inflationary push of what happened during the pandemic, and was the first one to go against the stream, so he can hold his own. The caution I have with Chris Waller is either he's extremely diplomatic, but I haven't seen him have thought leadership on changing the way that the Fed operates. Yeah. Kevin Walsh has said we got to do an analysis of what went wrong during the pandemic. We got to change the communication strategy. We got to do all these things. So while Chris Waller, for the time being, agrees with the administration, he is not going to institute any reform. But he is the more prudent choice than a Rick Reader, who would really be kind of let's put it this way. The day that Rick Reader went up in the prediction market to go above Kevin Walsh, the price of gold soared. Now, is that correlation or causation? Mm-hmm. I don't know. And obviously today the price of gold is up as well, and Rick Reader is falling somewhat. But and so one always has to be a little careful in putting a storyline into that. And by the way, as you may have noticed, I'm not even talking about Kevin Hassett, because he does appear to be out of the race. Yeah.
Do you think he has been taken out by Trump saying, "I need you to stay"?
I think so. It's a Kevin Hassett. He is he's like Rick Reader. He is far more he's open in communicating his thoughts. He seems to have a blast, by the way, in his job, and I use that term intentionally. He would have a blast being at the Fed and have fun rocking the boat. And it's it would be a Trumpian style, I suppose, a little bit. Let's keep in mind that he needs to get everybody on board, and it's just one voice there at the Fed, whoever it's going to be.
So some people see Reader and see, he's from BlackRock, and they just think, just putting the fox in the house, in the hen house. What would you say to that concern?
We used to, I think it is having people with that. I don't like Rick Reader as a Fed chair, but for other reasons. This is the least of my concerns. He oversees $3 trillion in fixed income, which means that, and most of the stuff is index-based, so it's not like he decides on every security that's in the portfolio and everywhere. But it means that he is the chief investment officer, so I don't know exactly how much administrative experience he has, because being the Fed chair is like being the cat herder in chief, and you need to herd academics. So he has no experience with academics. He has no experience with the government bureaucracy. But you used to have treasury secretaries that all came from Goldman Sachs, and then it became unpopular because people started to not like the big banks. But those guys had experience. They knew what they were doing. I much rather have somebody who knows what a bond is in practice, not just out of a textbook. And so that is something. So I'm not in that camp, but I get it. People like to badmouth everybody for whatever reason.
Well, I think the fear is, he'll just manipulate monetary policy to be favorable to assets because he's got all those, interests there. But honestly,
he's clearly in the manipulative camp, in the sense that he wants to use the balance sheet for more things. And the context here is that Ben Bernanke, he wrote his book during the pandemic where he said the toolbox that he created, that he was so proud of, is the baseline. And so there is this school of thought, and by the way, Rita has not articulated this explicitly, but I'm worried that he's in that camp, that you can micromanage the economy. And of course, when you do that, you're preventing failure. And while that may sound nice for the day, an economy grows through creative destruction. You need to allow failure. And there, Kevin Warsh, he is sometimes being criticized for being a bit more of a Reagan Republican type of guy, but he just focuses on the basics and needs the Fed to go back to basics. That's a good thing. Which is
when Bessent talks and he's chairing the search, it kind of sounds like that's what he wants, right? He wants the Fed to reduce its mission creep, right? Its gain of function.
Absolutely. Now, his boss is going to make the final call, though.
Yeah. Okay, we got to move on from this, just given time. So we're going to get to the miners. And Axel, you run a sizable mining fund, so you're a great guy to talk to about this. It's not like they haven't done nothing, although maybe silver miners, different story. But let's just sort of start with the question here. Why has gold risen faster than the miners of late? And then maybe particularly let's talk about silver, because over the past year, silver and the silver mining, at least the ETF, they're even, Steven. Like, we've seen almost no leverage effect there.
Yeah. I mean, to just give you an update, because you know those numbers, as of last night, this is before today's up move, we managed a little over 4.6 billion. Jeez. And the mining fund is currently over 1.6 billion. When we took that on, it was 230 million in 2019, and I don't want to mention any names here because I don't want to get into too many compliance areas. But that's a sign of how the space has evolved, right?
I'm sorry to interrupt, but 2 years ago, how much AUM was in the mining fund?
300 million.
Okay, so it shows you how much.
300 million to 500 million for a while. Yeah, we got to 500 million, and then we've gotten.
I mean, I know you've had new capital come in, but a lot of that is just
actually the mining fund is a closed-end fund. It's no new capital.
Oh, okay. So there you go.
Yep. No new capital. It's all internal performance. And there were dividends and share buybacks. Well, these things don't always move in tandem, right? And especially one of the challenges in the mining side is, how do you value that gold? And not just for the investor, but also for the guys operating it, right? If you want to invest in them and give them money for funding, well, one of the things that's happened now in some deals is that this is the price that's being paid, but if the average price of gold or silver remains above a certain level for the next, 2 years, then supplementary payments are due, because the buyers of these assets will obviously negotiate and saying, hey, we don't know whether this is a bubble or not, and so we'll apply $3,000 worth of gold, not $5,000. And so and it's not uncommon that when you have a short-term run-up, that the miners are not moving quite as fast. And it's, of course, and the ounce in the ground is valued far more conservatively than it has been in the past. Some of that is a good thing. You don't want that to happen too quickly. And for what it's worth, then if your opinion is that these precious metals are going to stick around for that price, then there's good value in these mining companies, of course. The one thing, kind of, since we're running short of time, I'd like to mention is that historically, when you have prices of precious metals run high, you have other cost factors also move higher. You have commodity prices move higher. You have the cost of labor move higher.
Right.
Energy is 25% of mining production many times, right? You have governments that want to have higher taxes. What is really noteworthy about the rally we've had is energy prices are very contained. Yes, labor costs are up, but not dramatically so. With some exceptions, governments have been well behaved and not demanding too much. And so this margin expansion has been going through the bottom line. And in the mining sector, right, the question is gold versus miners. Well, within the mining sector, sometimes the money moves to the majors, sometimes it moves to the junior companies. Historically, in a rally, the money first gets to the most liquid stocks, and then with an amplified impact to the more junior companies. And then the big miners have had some issues because they underinvested, then they got involved in these huge copper gold projects. They seem to be getting their act together. So there are movements within the sector based on fundamentals that make sense. And then there's been some profit taking. If I look at, I see a silver company today that's down, right, with the price of silver up substantially. That can happen, right, because there's been a big run-up. And so there's been substantial volatility, and that's part of what's happening.
Let me get to what I think is the spirit of what most folks are wondering here, which is, do the miners look particularly attractively positioned right now because the metals have moved so far so fast and are continuing to, but the miners haven't kept pace with their traditional leveraged performance as they have in past times? So is there a catch-up awaiting us here as long as the precious metals prices don't correct too hard in the near term?
Well, what I can say is that I'm on public record that I have not sold any of my gold mining positions, even though they've had a very, very significant run-up.
Okay.
You can see that in my public filings. And
I will interpret as continued optimism. You don't have to say those words, but I will interpret that.
And in December, I did sell a little bit of gold. I don't make any filings on that. And the reason was that I anticipated a Kevin Warsh Fed chair. And while as I indicated before, I don't think the Fed can change fiscal policy, all else equal, there might be a little bit of a headwind. Now, mind you, gold has had a substantial run-up since then. I'm not crying because I made plenty of money on those other things that I still hold, and I hold plenty of gold, more than I think most people do. But gold and gold miners, I hold more than most people do. And so but I'm not going to blame anybody for taking profits here, taking chips off the table. It may be the prudent thing to do to kind of to reassess your risk exposure. That said, if it is correct that this is a canary in the coal mine, that we have an administration that wants to grow at any cost. If we don't get fiscal discipline, if we get a ramp up in infrastructure and military spending, then there are very good reasons to hold them. And even if precious metals came down significantly, the margins would still be quite dramatic.
Yeah.
Right. And so I basically, and at the end of the day, I look at investing much more in terms of risk than anything else.
Mm-hmm.
Can you afford to take that risk? And I don't think I need to tell anybody who's ever invested in gold miners that space is notoriously volatile.
Yep.
And so people need to think about, can they stomach that risk? I heard the other day, and that's kind of one more of a red flag. I met somebody at a gas station, and he said he convinced his brother to sell his S&P stocks and buy physical silver. So that to me is more of a red flag, right?
The shoeshine boy effect, yeah.
Exactly. So that is the sort of thing. Oops, maybe. There is some caution, but based on the fundamentals on the mining side, I'm quite positively inclined.
All right. So just to note, Axel, our mutual friend, the coin dealer who lives near you, I think you know who I'm talking about. I've been surveying several different coin dealers right now, and I talked to him last night at length. He says it's the busiest he's ever been in his 60-year career in the industry. In terms
By the way, I think you can give his name. He knows an amazing amount of numismatics. If anybody is interested in rare coins, as you point out, he's been in the coin business for many decades. He likes to hold inventory, and he can make unusual requests happen. I've seen it happen in practice. Yeah. And then neither you or I get any benefit of him or anybody, but they can reach out to you or me, and if somebody's looking for that. And there are plenty of reputable coin dealers, but yes.
He's been around for a long time. He's actually helped launch a lot of big brands like the APMEX guys. He helped them get started. He's kind of a eminence grise in the industry. But anyways, he said this is the busiest he's ever been. Right now, it is primarily sellers, notably of silver. So we'll see. And look, I've been ringing a warning bell.
By the way, one of the things, I mean, right now he might just do anything, but one of the things he does during quieter periods is that when people inherit gold, they don't know what to do with it. They bring it to him. And then throughout the year, he travels to the countries of origin where he gets the precious metals from, because usually those coins are worth more. People value them more highly in those native countries. He goes to Hong Kong or India or wherever it might be and sells them there. And so he makes money the good old fashioned way by traveling and selling the coins.
Right. And great customer service. So again, not here necessarily to tout his wares, but obviously like you, huge fan of him. My point being is just what I'm hearing so far from the trenches is not, hey, everybody's coming out of the woodwork to buy because they got a shoeshine boy tip. It's more people who have owned precious metals and said, hey, look, I just got a 4X on my silver. I'm going to take some off the table. Or it's, wow, let me grab grandma's silver and just, try to cash in on it. Right. And look, Robert, like you and I and many folks I've talked to over the recent week, totally open to the fact that there could be a pretty painful pullback here at some point in time. But it doesn't, to him, like you, he doesn't necessarily fear that we're going to go back to like a 1980 or 2011, blow off top bust and have it be a nuclear winter for a while. And again, right now, it just doesn't seem yet, at least, that the shoeshine boys are driving, or modern version, the gas station guys are driving people to buy.
I mean, one way to look at it is that gold tends to drive to the people that can afford to hold it. It moves towards the small hand, to the strong hands, right? And so it moves to the coin dealer because people want to have cash. I'm not selling my miners because I can afford the risk to hold them.
Right.
And at some point I might, right? But for the time being, I sold a tiny position of something for tax reasons, but somewhere. But so I can't say I haven't sold anything.
No,
That's been.
So Rick Rule very publicly caught folks' attention over the past week or so because he says he sold a big chunk of his physical silver, and then he used the proceeds to de-risk a little bit. He took half of the proceeds, diversified in other Rick Rule type assets that he thinks are unloved right now, but will hopefully catch a bid at some point. And then took the remaining 50% of the proceeds and put them into silver miners. Do you feel similarly that right now the upside favors the miners versus the metal?
Yes, except there are not many good silver miners around to put the money in. Obviously, all this, there even a miner, and I'm not going to name the company, that used to produce silver has been caught in the updraft. And so...
Oh, really? Like they're getting the silver halo even though they don't mine anymore?
Yeah, so that can happen as well, which is there are... Obviously, there are some silver companies that do well, and we own some of them, but it's not that even. Silver tends to be a byproduct,
right.
And so it tends to be not the primary commodity, and so one has to be a little bit careful at how one deploys the money there.
Okay. All right. Well, look, Axel, I'm going to wrap it up here. Thank you so much for joining us again, giving us all your time and expertise, both on the Fed and on precious metals. You're a great twofer like that. Folks, please do me a favor. I always ask this, but I always love, getting the confirmation from you all. If you enjoy and value having Axel coming on to do these live reaction videos with me after every Fed or FOMC release and Fed chair presser, please let me know, because I want to do more of the things you want and less of the things you don't want. Please also thank Axel for continuing to do this and coming on and doing, again, yet another great job today. And Axel, as long as folks want, which I'm guessing based on past results, is going to be forever. Just want to thank you for being willing to come on and do this with us in the future every time we've got a Fed update.
And it's going to get, today was a snoozer, but we're going to get pretty soon into with the new Fed chairs. And by the way, just as a reminder, the reason we care about the Fed is because they control the bazooka, they control the reference of the risk-free rate. They are so significant and in charge of inflation expectations. Obviously, debt spending drives inflation more than anything, but that's why we do that, because it's an important reference point for our investments.
Yeah. All right. Well, look, everybody, please thank Axel by hitting that like button and then clicking on the subscribe button below and that little bell icon right next to it if you haven't already. Axel, for folks who want to follow you and your work in between now and your next appearance, where should they go?
merkinvestments.com is the website. And Twitter, I'm at Axel Merk. And I'm on Substack now, most recently. You get there from merkinvestments.com, but merkinsights.com. But you can get there from merkinvestments.com. Just the latest newsletter is going there. Yes, I'm trying to move with the times and publish there as well.
I don't yet have a little banner here for merkinsights.com, but I'll get that ready for next time. Folks, just a reminder too of two things. One, if you weren't aware of it or are late to the game and want to increase your exposure to silver, Andy Schechtman, the CEO of Miles Franklin, which is the endorsed precious metals solutions partner for Thoughtful Money, is continuing to offer his special offer to this audience of being able to buy junk silver from his business for, I think it's 99 cents above spot. So if you want to take advantage of that, go to thoughtfulmoney.com/buygold. And if you've got precious metals questions or need above and beyond just that junk silver offer, Andy and his team are totally happy to answer any of those questions and help you in any way they can. Again, just go to that same URL. And then last, if you want to get some help from a professional financial advisor in terms of just trying to figure out what type of exposure should I have to precious metals? In what form should I hold them? Metals, paper ETFs, miners, etc. If you're sitting on big gains and have questions about how to hedge them, all these questions generally are unique to each of us based upon our own personal situations, our own goals, risk tolerance, tax exposure, etc. So highly recommend that you get that advice from a good financial advisor who's quite experienced in the precious metals market. If you've got a good one who's advising you on that, great, work with them. But if not, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. So to do that, just fill out the very short form right there at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service they offer to be as helpful as possible. Axel, thanks so much, buddy. As usual, I'm going to give you the last word here. Again, somewhat of a snoozer of a press conference, but still obviously a lot to talk about. Whether it's the Fed, whether it's gold, whether it's just the markets in general, do you have any parting bits of counsel for today's audience?
Well, fasten your seatbelt and look in the market at the markets in terms of risk more than in terms of opportunity, especially when things are going as well as they have been.
Okay. Yeah. Okay. That makes sense. Don't get too caught up in the FOMO. Don't forget to play defense while you're playing offense. All right, my friend. Thanks so much, Axel. Very much appreciate this. Obviously, the comments coming in here, super supportive of you and super grateful. Thank you so much. So, Axel, I'll see you again next time. Everybody else, thanks so much for watching.
If the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
An official U.S. gold revaluation, raising reserve valuations to today's market rate, would inject immense book value into the Treasury, 3% of GDP, improved balance sheets, and reduced debt pressure. However, this accounting shift could undermine confidence in the dollar, causing investors to flee into gold, silver, and other non-dollar assets. If the dollar is redefined and devalued against gold, it would essentially devalue U.S. Treasuries and cause interest rates to spike soon after. Past gold revaluations, 1933 and 1971, acted as dramatic tools to address monetary crises, devaluing the dollar sharply and resetting economic expectations. Current parallels are being drawn to the 1971 Nixon shock and potential similar systemic shifts. Investors retreat from the dollar, shifting toward gold, silver, and alternative assets. Rafi Farber, the publisher of The Endgame Investor on Substack, explains that short-term fluctuations remain, with gold prices reacting to data-driven dollar strength. Still, markets anticipate rate easing ahead, which could favor bullion again. Commentators warn that even entertaining the idea of a gold revaluation points to eroding faith in fiat money and public finances. It's seen more as a Rorschach test reflecting systemic anxiety than a mainstream policy plan, but one that signals how close some policymakers are to the edge. The UBMA and COMEX are experiencing record delivery demands as institutions shift to physical gold amid concerns about counterparty risk. Historically, gold revaluations fuel inflation, but a move today could be far more severe, potentially undermining the dollar's fiat status and forcing a systemic reset in gold and silver terms. This comes as de-dollarization accelerates, with gold overtaking the euro as the second largest reserve asset and central banks buying at record level. Watch closely for our professional insight. Click the subscribe button and enable notifications to ensure you don't miss any upcoming material. Thank you so much for your support.
August 1st, some guy who works for the Fed who has a degree in BS economics. I know it's a BS in economics, but what's the difference really? He published an article on the Fed's website about the prospect of gold revaluation and previous gold revaluations that have happened and how they basically had no effect on anything important, except the 3 cases of gold revaluation that he cites are completely insignificant relative to the ones that he does not cite, and those are the one in 1933, which revalued gold 66% higher from 21 to 35, and the devaluation of the dollar in 1971 relative to gold, when the final gold window was finally closed. But he doesn't mention either of these and their effect on inflation, or what he calls inflation, which is the rise in consumer prices. I will show you how gold revaluations severely affect price inflation as defined by the Keynesians with 2 simple charts, and why this gold revaluation, if and when it happens, is going to be at least 60 times worse, because the revaluation would be a mark to market, and even assuming the market price remains at 3,400 whenever this passes, and it won't remain there, the effect of a gold revaluation on the dollar and prices will be extreme, and it will lead to the end game almost certainly. One thing I noticed on Gold Charts R Us. This is a great site that I have a subscription to, and I recommend if you really follow the gold markets, it is very helpful. I looked at the gold future spread because I noticed that there was a record low spread between the 2-month and spot rate, which we'll get to in the next chart. With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Now it's $3,400. So what would that mean? If you read this article, which I'll put in the link in the description below, it's full of a bunch of crap, which talks about some insignificant gold revaluations in the past few decades, but totally ignores the big one in 1933, 1934 of $21 to $35 a troy ounce, and then the big one in 1971 from $35 per troy ounce, or $42 per troy ounce, to whatever the market says, which was a gold default. What happened to prices in both of these circumstances? We're going to look at food prices in the immediate aftermath of these revaluations. You'll see it's not good. Here's what Craig Hemke says on the situation. I will link his article in the description below. In the end, Craig says, connecting all the dots for this picture is about as simple as a children's workbook. The politicians are warning you that an official gold evaluation is coming, and the price action since Trump was elected is telling the same story. The only question, what becomes of the market price for gold when this official revaluation happens? And he says, no one knows. Seriously. Well, I do. I just don't know exactly how long it's going to take from the official revaluation to endgame. I don't even know if we're going to make it as far as an official revaluation before the market forces it. But anyway, I'm going to finish his paragraph and then explain why I believe this is so. How could anyone be certain, as no one alive today has lived through the unofficial U.S. government evaluation? Well, I would say that we can still look at the data of an official U.S. government evaluation, and some people who are alive today have lived through it, those who were born in the 1920s and they're centenarians, and they were teenagers when it happened in 1933. Some of them are still alive, and we can find some of them. Anyway, if the U.S. just simply uses a London PM fix of, say, June 15th, 2026, and what does that mean for the gold price on June 16th? Probably nothing. However, it speaks volumes regarding the value of gold as something other than a barbarous relic. Additionally, other central banks and governments around the world may follow suit and issue their own official revaluations. Absolutely. If the U.S. government revalues its gold, of course, the other governments of the world will revalue theirs. And usually we're talking about the central banks here and not the government. But why do I think that the price of gold will head up higher very fast when there is an official gold revaluation mark to market? Well, here is some of the evidence, and then I'll give a logical explanation. First of all, the gold revaluations and inflation below was a 66% revaluation. This one would be 60 times larger than that, because we'd be revaluing gold from $42.22 to about $3,400, which is 60 times larger than the 66% revaluation of 1933. So here you can see these are food prices. I'm going into food prices because I want to know how a gold revaluation was followed. I'm not necessarily going to say affected by directly, but was followed by a huge spurt in food price inflation increases, which means that basic necessities got extremely expensive once the revaluation happened shortly after. You can see here that April 1933, food prices were going down 15.3%. By March 1934, less than 1 year later, food prices were rising at an annual clip of 22.3%. This was only on a 66% revaluation of gold, meaning devaluation of the dollar. Here is the August 1971 gold default. You call it a revaluation, dollar devaluation. It's all the same thing. The August 1971 gold default went from a 3.5% rate in food price inflation in August 1971 to 20%, 19.8% by August 1973. Just about 2 years later, we had the major stagflation of the 1970s, and the only way it was brought down was by the Treasury selling its gold reserves off to try to suppress the price of gold. And now, from a logical, positivist perspective, why would marking gold to market raise the price of physical gold enormously and then lead to huge amounts of food price inflation, which is really the most important part of the Keynesian definition of inflation, because when basic necessities become unaffordable, people start to riot. There are several ways to think of it. The simplest one is this, that gold at the Fed on its balance sheet is not convertible. You cannot go to the Fed with your dollars and get the gold that it has in its basement. What you can do is you can buy gold at a coin shop.
Farber turns to the present and notes that gold has been consolidating for almost 4 months. However, gold miners have already started to appear. In the past, gold has typically followed miners, who set the pace for upward mobility. While gold prices stayed mostly steady, mining equities increased by about 25% in August alone. With miners indicating the next step higher for bullion, that divergence implies the consolidation may be coming to an end. Discovery Alert notes bullish breakouts in miner performance relative to both gold and broader markets. The ratios of GDX gold and GDXJ gold are climbing from multi-year lows, suggesting that mining stocks are attracting capital away from traditional equity allocations, a sign of strategic rotation. Analysts warn that an official gold revaluation could trigger a massive dollar devaluation. This revaluation would be among the most dramatic ever, far outpacing the 1933 and 1971 gold devaluations. Still, experts caution that it amounts to more accounting ingenuity than genuine monetary reform. While it might help with short-term fiscal optics, the underlying risk to inflation, dollar confidence, and debt sustainability would likely remain unless paired with fundamental economic changes. Now, let's shift our attention towards the interview.
195 grams per ton silver at the galleon target, 3.8 grams per ton gold at the horseshoe target. We've got copper, zinc, lead, antimony, gallium, indium, and tin. Rumor has it that Putin will be there soon, and he might take a look at the resources. I don't think he actually will, but it's an interesting coincidence. Now that, let's go to the charts and an explanation why a gold revaluation would lead to a quick dollar devaluation from an Austrian school positivist logical perspective. For our first chart today, people have been asking me how long is this consolidation in gold going to last, and silver as well. Well, we're at nearly 4 months now, or a little bit past 4 months, about 4 months. We can see here that the candles are the price of the gold miners as represented by the GDX and GDXJ ETFs. We can see here they're both headed higher as of the beginning of August relative to gold, which remains in consolidation. The miners have broken out. When the miners tend to lead gold, that means that gold usually is at the end of its consolidation. Miners usually lead gold in their move. If miners are headed down and gold is not yet, that usually means that gold is headed for a dip. If miners are headed up and gold is not yet, that usually means that miners are leading gold higher. This consolidation is about to end. In my humble estimation, that is. You can see here that miners are up about 25% for the month of August, and gold has been relatively static. Where are we in terms of how nervous the Treasury is getting? before there is something bad that happens in the monetary system? Well, it looks like Scott Bessent, our favorite Treasury Secretary, is getting pretty desperate because he's begging the Fed to cut rates 150 basis points. From Bloomberg, U.S. Treasury Secretary Scott Bessent made his most explicit call yet for the Federal Reserve to execute a cycle of interest rate cuts, suggesting the central bank's benchmark ought to be at least 1.5 percentage points, that is 150 basis points, lower than it is now. I think we could go into a series of rate cuts here, starting with the 50 basis point cut in September. That's what he wants. Bessent said in a television interview on Wednesday, if you look at any model, whoa, those models got to be hot. It suggests that we should probably be 150, 175 basis points lower. I wonder what model he's looking at. It costs to lease gold for 2 months. It costs here 3.18%, which is an all-time record high. This was about 2 days ago. And so this is one indicator of gold backwardation. I don't think it's going to stick yet, but if gold is flirting with backwardation because gold now is worth more than gold in the future, which is a backward-dated state. And another word for endgame is permanent gold backwardation. The gold that you can physically hold in your hand is worth $3,400. And that is the premium that people are willing to pay over the gold that you cannot, which is $42.22. Now, if they market to market, that means that gold that you cannot hold in your hand is worth $3,400. Then therefore, what is the premium gold that you can actually own yourself? Well, we don't know exactly what that premium is going to be, but it's going to be a lot higher than $3,400. And it could take a few days or a few weeks or maybe a month to catch up for the premium to start to rise. But recall that the strongest gold rally in history was from 1971 to 1973, which was even stronger in percentage terms than the rally from 1978 to 1980. I know often it doesn't seem that way, it's not thought of that way, but the strongest rally in gold was right after the revaluation or the devaluation of the dollar in 1971. We're going to see something very similar in gold prices if and when there is an official gold revaluation. The other way to think of this in terms of the Misesian regression principle is that all transactions in dollars are based ultimately on promises for gold, because that is how the dollar was born. And because all economic transactions today flow from all economic transactions in the past, it's like thinking about time travel. If you go back in time and change an event in the past, it's going to change all events in the future. So if you change economic events in the past, obviously they will also change economic events in the future. And the economic events of today are still based on the assumption that gold that is owned by the Fed is payable at $42.22 an ounce by dollars, which are the Fed's liability. I understand that people do not actually believe this, but because the economic transactions of today stem from those of yesterday and prices of today stem from prices of yesterday in gold terms, that means if the definition of a dollar is changed and devalued against gold, it is really a devaluation of treasuries, and therefore interest rates are going to skyrocket very shortly after this gold revaluation. And I don't think it will take very long for the end game to hit once this is actually done. We've seen how it affects prices in the past. We know this one is going to be a lot huger than the one that was in 1933 or the indefinite one that was put in place in 1971. This one is going to be monstrous and is going to lead to the end of the treasury market and the end of the US dollar as a fiat currency. And then everything is going to be repriced in terms of gold and silver, of course, when the public realizes it can't get any gold and the only thing that it can get its hands on are perhaps a few ounces of silver, and then we will head into a new era.
The possibility of a revaluation of U.S. gold highlights the financial system's severe structural stresses. Although doing so could momentarily strengthen the government's balance sheet, it runs the risk of inciting inflation, undermining trust in the dollar, and hastening the world's shift toward gold and silver. In addition to reflecting monetary history, the discussion highlights the vulnerability of the current fiat system in the age of de-dollarization, as gold miners have already signaled to the market that they expect bullion prices to rise. Would a revaluation of gold signal the end of the US dollar's position as the nation's reserve currency? Do recent advances by gold miners portend an impending bullion breakout, or are they merely another transient divergence? Post your thoughts in the space provided for comments. Join our community by subscribing to our channel and enabling notifications using the bell symbol if the video resonates with you. We appreciate your participation in our community.
I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up. Because by the time the ETF buyers have a shot, they can be looking at much higher prices. Same thing with gold. I mean, maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Gold hit a more than 4-month high on Monday, as increased bets for a U.S. Federal Reserve interest rate cut this month lifted bullion's allure, while silver rose above $40 per ounce for the first time in more than a decade. Peter Schiff expects a strong move higher, possibly as early as Tuesday, and advises buying silver now before prices jump, since ETF buyers might face much higher levels. The same goes for gold. If it gaps above $3,500, that would be a significant $50 move, supported by both strong fundamentals and technical momentum that could trigger a breakout. Peter Schiff, an American stockbroker, financial commentator, and author, highlights that gold appears to be entering its next big rally, likely beginning when it broke above prior highs on Friday, setting the stage for a quick move toward $3,500. As of early Asian trading on Sunday, it was around $3,448 after briefly topping $3,450. Silver also hit a 13-year high Friday, closing just shy of $40, and is now trading near $39.72. Both metals look technically and fundamentally strong, helped by a weaker dollar index, which closed below 98. The U.S. bank holiday is contributing to thinner liquidity, which is also exacerbating some of the moves in gold and silver. Silver is making a move higher in response to expectations of lower U.S. rates, while a tight supply market is helping to maintain an upward bias. Peter Schiff recalls predicting a golden age for gold during Trump's presidency, noting that while Bitcoin is being promoted as digital gold, it has underperformed, trading below its prior peak despite hype, ETFs, and official support. Gold, by contrast, is hitting record highs, far outpacing Bitcoin and stocks. They warn that Bitcoin looks like a pump-and-dump scheme and suggest converting it into gold or silver instead. Let's dive into Schiff's video for more insights. If you find the content engaging, please consider giving us a positive review and subscribing to our channel to receive the latest updates.
Gold, I think, is finally getting ready for the next leg up. In fact, it probably started that leg up on Friday by going through the highs. But now I think we've got clear sailing to get up to 3,500. I think we'll pass that relatively quickly. In fact, I'll take a look at where we're trading right now. Early Sunday evening. So Asian trading has just kind of kicked off. And in the gold market, let me pull that up. Yeah, no, gold's down about 90 cents, 3,448. A few minutes ago, it was trading above 34.50. Silver also on Friday. Silver closed at a 13-year high. We came within 10 cents of $40. Right now, we're trading at 39.72, which is up about a dime from where we closed on Friday. But both gold and silver looking very strong, technically, fundamentally. The dollar was also weak on the week. Dollar index closed back below 98, about 97.80. So weakness in the dollar also working to help the gold market. But I think there are major, fundamental stories that are going to be fueling this gold market rally. I said it on this podcast when Donald Trump gave his first speech as president and announced the golden age in America. I said he's right in a literal sense. It was going to be a golden age for gold. And so far, gold is off to its best start probably of any presidency in history. Trump may not be making America great again, but he's making gold great again, not by intention, but the unintended consequence of his policies, right? He's trying to tout Bitcoin. Bitcoin is only up about 14% on the year, right? Gold is killing it. In fact, Bitcoin is 13% below its peak, right? Clearly, it's not digital gold. Gold's making a new record high. Bitcoin's in a correction. It could easily enter a new bear market pretty soon. And of course, the stock market is, gold stocks are crushing the returns in Bitcoin. But Bitcoin is still today about 13% lower than it was at its peak 4 years ago if you price it in gold. So despite all the hype, all the Bitcoin ETFs, the Bitcoin treasury companies, the strategic Bitcoin reserve, America being the Bitcoin capital of the world with the first Bitcoin president, Bitcoin is still lower than it was before any of that stuff happened. So how is that possible? How can all this good news and all this new buying not drive the price higher? Because there's a lot of people smarter than the people who are buying who have been selling into all the hype. This is a gigantic pump and dump that's going on with Bitcoin. And the big pumpers now are the Trump administration, and all of their friends are the dumpers. But if you're smart, you'll get rid of what Bitcoin you have, and you'll go down to Shift Gold, where we work with BitPay, and you'll take your Bitcoin and you'll buy some gold or you'll buy some silver. This is a holiday weekend, so the U.S. markets are closed on Monday. I would not be surprised to see silver gap above $40. It never touched $40 in U.S. market hours on Friday. But I would not be surprised to just see silver gap above $40 and just have a big move up on Tuesday. So I would go to Shift Gold now or tomorrow and get some silver. Don't wait for that big move up, because by the time the ETF buyers have a shot, they could be looking at much higher prices. Same thing with gold. Maybe gold will gap up. I'd love to see gold gap above 3,500. That would be something. That's going to be that's a bigger move, because that's about a $50 move for gold to do that. But there's so much that's going on right now, fundamentally, technically, that would support that kind of breakaway gap in these metals.
Peter recalls how mainstream financial media often ignored gold, even when it was making major moves. He remembers being on CNBC years ago when gold had risen about $40. To him, that attitude showed a lack of understanding, because gold isn't just a commodity, it's money. Historically, even Alan Greenspan used gold as a key measure of monetary policy, warning that high prices signaled excessive looseness. Today, with gold around $3,450, it's clear that monetary policy has been far too loose for decades. Central banks themselves treat gold as the most important asset, stockpiling it while shunning other commodities. Rising gold prices, Peter Schiff argues, are a warning sign of deep economic problems in America, yet many still dismiss it while hyping Bitcoin instead. He stresses that central banks, the insiders of the fiat system, are effectively dumping dollars in favor of gold, signaling a loss of confidence in paper money. Investors should follow their lead by shifting into gold, silver, and international value stocks, which are already seeing strong returns as money flows out of U.S. assets. Now let's dive into the interview.
They barely talked about gold, as gold was making all-time record highs. I still remember when I went on CNBC back when they still had me on. I hadn't been on like 10 years. I don't know. I can't remember when I was on. But when I used to be on every week, but when I first started going on, I was on Squawk Box, and the host was this guy, Mark Haynes, who passed away quite some time ago now. But the first time I was on, of course, I discussed the price of gold, and I think it was still below 300, or maybe it was in the low 300s. I forget. But I came back, I don't know, a few weeks later, and I'm in the studio again talking to Mark Haynes. And I said, Mark, gold's up about $40 since the last time I was in this studio. And his response to me was, who cares? Who cares about the price of gold? And, he mentioned a number of things where he cares about the price. But he says, I forget, maybe it was bread or oil, I forget. But he said, why should I care about the price of gold? Right? He is the anchor in a financial news show. It's supposed to be focusing on finance, investing, economics. And he says, who cares about the price of gold? I mean, how could you not care about the price of gold? Only if you just don't understand what gold is. I mean, gold is money. It's you're a show about money. How could you not care about gold? And when the price of gold is going up, especially like this, it is a warning. It is telling you that there's a problem, right? I mean, even Alan Greenspan, I talked about this, he used to use gold as his primary reference to know whether or not he was too loose or too tight. He used to say that if gold gets up near 400, I'm too loose. If it goes below 300, I'm too tight. Now, what does that say? Look where we are now, 34.50. We've been too loose for decades based on Greenspan's metric. But the gold is the most important price. It's not just a precious metal. It's not just a commodity. It's a monetary metal. Central banks are holding gold for a reason, right? How could you say, I don't care about the price of gold? Well, what about all these central banks that are hoarding all this gold? Don't you think that's significant? Because, they're not stockpiling other commodities. They're owning gold for a reason. It is the single most important price out there. And right now it is screaming that there is a huge problem. There is something rotten in the state of America. And that's what you're seeing in the gold market. And, I'm sure that mentality still exists today. The same one that Mark Haynes had, even though he's not around anymore. I think that idea that who cares about the price of gold, right? What's the big deal? It's nothing, right? It's just a rock, right? They care a lot more about Bitcoin than they do about gold. But if you understand what gold is saying, it is a warning. And it's a warning that you had better heed and that you better react to. You better get out of dollars. You better get into gold and silver. That's what the central banks are doing, right? Follow their lead, right? They ought to know. They're like the insiders in the fiat money system, right? So if you see in a company, if all the managers are dumping their shares, they might know something that you don't. Well, this is basically what's happening. The managers of the fiat monetary system are dumping their dollars. They want out. And they're buying gold. They're not buying other currencies. They don't want another fiat currency. They want real money. You should do the same thing. And the same thing is happening with investors. Not necessarily in gold, but they're dumping their U.S. shares and they're buying back their own stock. Right? That's why, my dividend payers fund is almost up 40% on the year now. It's at 39%. It's on the high of the year because value international dividend paying stocks, that's where people are putting their money now. That's where when they sell in their U.S. stocks and they sell their dollars, they're bringing their money home and they're buying value. They're buying income, right? They're buying these dividend paying stocks. I think we're still early in this trend.
Gold and silver are showing clear signs of entering powerful new rallies, with central banks and investors driving demand while the dollar weakens. Peter Schiff emphasizes that gold's record highs are not just a market trend but a warning of deeper economic issues tied to excessive money printing and debt. He argues that unlike Bitcoin, which he views as speculative hype, gold and silver remain true stores of value and the assets central banks themselves trust. For investors, the message is clear: follow the smart money into precious metals before the next breakout accelerates. Do you think gold's rally toward $3,500 will trigger broader recognition of it as the ultimate safe haven? With silver nearing $40, Could this be the start of a long-awaited move into triple-digit prices? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and so right now this weekend, in fact, at the SCO meeting, the Shanghai group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia. Now they're the best friends after this meeting this weekend, and we always try to prevent them from putting an alliance together. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the U.S. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all.
At the 2025 SCO summit, India's Prime Minister Modi met with Xi Jinping and Vladimir Putin, signaling warmer relations. China, Russia, and India strengthened ties in response to U.S. tariffs and Western pressure, presenting the SCO as a rising economic bloc independent of Western institutions. Together, these nations represent 36% of the world's population, giving their partnership significant economic weight. With China secretly stockpiling gold and reducing reliance on the dollar, this alliance highlights a global power shift and exposes U.S. vulnerabilities in trade and finance. A 49-year veteran market expert, Bert Doman, recalls that since 2007, market manipulation has become much easier due to the removal of the uptick rule, which had been in place since 1933 to prevent short-selling abuse. Its removal opened the door for high-frequency and algorithmic traders to heavily manipulate markets. Many believe the SEC protects investors, but in reality it often protects insiders who benefit from such moves. This makes rallies risky, as they can be engineered, and safer bets like gold and silver have offered better returns during uncertain times. Looking at history, gold peaked at $800 in 1980 before entering a 20-year bear market, just as cycle studies had predicted, Bert Doman says. The bottom came exactly in 2000, aligning perfectly with long-term trends. Analysts had already forecasted back in 1980 that after this cycle, gold would begin a powerful secular bull market. Unlike shorter cyclical swings, a secular trend is long-term, and the current rise in gold is part of that ongoing secular bull phase. As we play snippets from the video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
No, with the manipulation today, it's easy to be wrong. For 48 years, we basically called most market tops within a day or two. Okay, and that was using advanced technical analysis. It's become tougher since 2007. In 2007, they made it possible for the high-frequency trading and the algo traders to sell short without waiting for an uptick. We had the uptick rule in place since 1933. It was Joe Kennedy, who was a big manipulator in the 1929 crash. He and his guys crashed the market in 1929. And then they made him head of the SEC. And he said, well, if we would have had an uptick rule in place, we could not have manipulated the market downward. That means that if you put an order in to sell short, the order before that had to be on an uptick, a higher price, even if it's only at 1/8. And so that uptick rule was in place in 1933. And in 2007, they did away with it quietly. And we read it and said, oh, something is up. There's going to be a crash next year. And they want to make a big big money out of that. And of course, we had the crash in 2008. So this was all manipulated. People have no idea. They think the SEC is there to protect them. No, the SEC is there to protect their friends. So a lot of money is being made with these manipulations, and so the up move in early April in the stock market, we said that it's going to be a bear market rally, but we'll probably have a couple of the indices making new highs by a small amount. But we don't want to play this. This is too dangerous because it doesn't necessarily have to happen that they will go as far as a few indices making new highs. So we sat that one out. Yes, we could have made a lot of money in that rally, but we had gold and silver and they made a lot of money for us. And then you asked about gold before. In 1980, gold had hit $800 an ounce. Okay, so we were along for the whole ride from 1977 onward. 77 is when I started my business, and so we were along for the ride. But then we got a sell signal on our indicators. We said, "Okay, time to sell, take profits." It's been fun, and then we did a cycle study on gold going back 400 years. So that was about 200 years in the U.S. and 200 years we had to go to the data from Britain. And so we said, okay, this is going to be a 20-year bear market in gold. People thought that was crazy because everybody was still waiting for $3,000 gold at that time. But it happened. When was the bottom of that bear market? Year 2000, exactly 20 years after 1980. And it was amazing to us even because usually cycles, they move a little bit to the left or to the right, they're off by a few years and so on. But the bottom was in the year 2000. And, people want to know what the second part of the cycle study said is how far the next up move would be. So far, it's correct. Okay. Mm-hmm. So we said in 1980 how high this market would rise, the current bull market. It's a secular bull market. You always have to differentiate between a cyclical bull and bear market and a secular. Secular is very long term. Yeah.
Bert Doman point out that in the first phase of a market crash, investors facing margin calls sell whatever they can, including gold and silver, causing their prices to drop temporarily. But once that urgent selling is over, gold and silver rebound strongly as people seek safety while central banks print more money, eroding its value. That's when these metals shine as the only true protection of wealth. At the same time, India's warming ties with China and Russia at the SCO summit mark a shift toward a multipolar world, as the three nations, representing over a third of the global population, find common ground against Western dominance. Analysts warn that U.S. tariffs, especially on India, may be backfiring by driving these countries closer together. If they retaliate with tariffs or reduce trade, U.S. supply chains and retail sectors could face major disruptions, underscoring America's vulnerability in this shifting global balance. Now, let's recall the interview.
See, in the first part of a bear market, when the markets just tumble, and everybody has to scramble because they're getting margin calls. So they sell what they can't sell. And gold and silver, of course, it does have bids, and then they will sell that too. And in the first phase of a decline like that, gold and silver will be declined because it's being used as a source of cash. To meet margin calls. But then comes the second phase, and that is when all that is, urgent selling is out of the way, and that is when you really want to buy gold and silver. That second phase, because then everybody goes to safety. And gold and silver is considered the only safe thing, because the central banks then will step on the accelerator, manufacture as much money as they can, as they did in the year 2020, 2021. And that means that your money is worth less. The purchasing power of your money declines, and the only safety for that is gold, silver. Mm-hmm. They will go up. So gold and silver, gold has been an island of safety for thousands of years. It's not going to change. I think they know what's going to happen, what is inevitable. China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and so right now this weekend, in fact, at the SCO meeting, the Shanghai Group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia, now they're the best friends after this meeting this weekend. And we always try to prevent them from putting an alliance together. Now they are the best friends. Now this is together. These three countries have 36% of the world's population. That is a big amount. 36%. Do you know what the U.S. is? U.S. is 4.1% of the world's population, and this is where Mr. Trump is so wrong. He thinks that everybody needs the U.S. consumer. Okay, he's wrong. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the U.S. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all. We don't need their consumers. We've got enough consumers outside of the United States. And in fact, we don't even have to do anything more. We don't even have to supply them with our stuff. We're just not going to even sell to the United States. Can you imagine if these three nations suddenly decide not to sell their stuff to the U.S.? The shelves at Costco and Walmart, etc., Target, they're going to be bare. Because you take a look at all the merchandise you see on those shelves, turn them upside down and see where they're made. They're made in these three countries, most of them. So I think we are much more vulnerable to them boycotting the U.S. than us boycotting them.
Both Bert Dohman's market insights and the geopolitical shifts seen at the 2025 SCO summit point to a world entering a new phase of financial and strategic realignment. As gold and silver continue to prove their long-term resilience, the strengthening alliance between China, Russia, and India adds another layer of pressure on U.S. dominance. These converging trends suggest that investors and policymakers alike must prepare for an era of heightened uncertainty and rapid change. Could the growing China, Russia, India alliance accelerate the decline of U.S. financial influence? Will gold and silver remain the most reliable safe havens as global markets face manipulation and geopolitical upheaval? If you like the analysis, then share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.